In July 2025, the United States issued a sharp warning. India could face a 25% tariff on its key exports unless it stops buying oil from Russia, a bold geopolitical move with real economic weight. Even as the West enforces sanctions on Russia, India has continued importing discounted Russian oil. For India, it's a practical choice. For the US, it's a red flag. The pressure is now intensifying. The US is considering secondary sanctions, targeting countries that continue trading with Russia. This could reshape India's trade landscape. India's textile industry is one of the first in the firing line. With the US as its biggest market, even a modest tariff could cause order cancellations and job losses across the sector. Next comes pharmaceuticals. India supplies about one third of America's general drugs. A 25% duty here could disrupt supply chains and squeeze Indian pharma giants. Auto component makers like Sona Comstar and Bharat Forge and capital goods exporters are also watching closely. These sectors may not make headlines, but they will feel the impact. At the center of it all is oil. Russian crude has been a cost saving lifeline, but sticking with it now could come at the cost of strained US relations and lost export revenue. What about tech? India's IT and services sector isn't directly affected, but if American companies tighten their budgets in response to global trade tensions, Indian tech contracts could take a hit. This puts India at strategic crossroads. Stick with affordable Russian oil or adjust course to protect vital trade ties. It is less about choosing sides and more about choosing priorities. Still, it's not the end of the road. India has options: a large domestic market, global partnerships beyond the US, and growing economic strength. Challenges may rise, but so will opportunities.